Laura, I remember back in June you said, look, we're at the final leg of this bear market. Where are we now?
That's right.
How long is that leg?
That's a long leg.
It's the final leg, but it's a very extended leg. That's also what I said. So I think here's the deal, right? We're not in a rush to turn outright bullish at the index level. We're still seeing a number of factors that's moving around and could cause the volatility to remain high, at least in the near future. For example, the COVID-0 policy, whether there's going to be a clearer exit roadmap, particularly after the party Congress, and whether the housing market could show some early signs of stabilization after September and October, which historically have been proven to be better season for housing sales. And then, of course, we know that PCAOB will start their audit inspection starting from next week, and whether that inspection could yield a positive outcome. So all of these moving parts will actually keep the market in a relatively volatile state in the near term.
Right, and arguably those three main potential catalysts are very slow moving. You know, you don't get a change in those three overnight, do you? So it might just take a long time.
I would agree. This is why, as I said, we're not in a very rush to turn outright bullish. But at the same time, we maintain our overweight stance in the Asia market. We have been recommending investors to put more money in Asia market versus the offshore space. This is because we're seeing the credit growth pick up in the Asia market, in the onshore space, and that gives a lot more liquidity support for Asia's versus the offshore space, which is much more subject to the Fed tightening policy and the global risk-off sentiment.
You have 9 metrics that you look at in the Asia market in terms of gauging where sentiment is. What are some of the elements, maybe the top, maybe a few ones that you could pick that you need to actually have and it's necessary to have a sustainable rally?
That's right. I think trading volume. First and outmost is the trading volume. We look at the broad Asia market trading volume, the index future trading volume, which shows how people hedging their position, and then the northbound trading volume, which is a good indicator in terms of global investor sentiment towards the Asia market. So I think those would give you a good sense about how excited and engaged investors are about the Asia market in general.
And what do you think is keeping those metrics constrained, apart from obviously the Fed, and you mentioned already Hong Kong and that money getting sucked out of Hong Kong, for example?
Right. I think sentiment about the macro outlook is very important. At the beginning of this year, the government has set a 5.5% GDP growth target for this year. Morgan Stanley is expecting only 2.8%. So there has been a lot of downward adjustment in terms of expectation about job growth, about your income growth, and about investment cycle expectation. So all of these feed into corporate earnings disappointment so far we've been seeing.
Do you think we'll see more downgrades in earnings expectations then?
Yes, that's what we are expecting.
How much more?
We are forecasting 8% earnings growth in our base case for MSCI China for this year. Consensus is about 10%. But given the uncertainty in the housing market and whether the COVID situation would potentially last longer, we see a rising chance of earnings growth to decline to around mid-single digit.
And what do you look at in terms of where those downgrades are coming from? Because this earnings season, I mean, mostly were pretty bad, but if you take a look at energy, that was the outperformer, and some surprises in technology too.
That's right. Technology companies, these internet companies, have been engaged in very aggressive cost-cutting measures, so they turned out to be a bright spot. But otherwise, it's been a rather broad-based, disappointing season in the second quarter, particularly on the consumer front. And given that coming into the third quarter, we have the unexpected resurgence of COVID onshore with a number of cities getting into the lockdown situation. So I wouldn't be expecting a lot of positive outcome in the third quarters for consumption-related earnings results.
Now, once things become more clear on the consumption side to the COVID-0, what would be the first sector you think you'd be excited over? What would you buy first? What looks mispriced now, but you can't act on it until that happens?
Until the COVID-0 policy gets more relaxation?
Or at least clarity on it.
Yes. I think the reopening theme has a number of beneficiaries. Particularly on the tourism side and with the general consumption. And surprisingly, actually, some of the healthcare names would also benefit from more stabilized and normalized hospital traffic, etc.
Are you expecting more policy clarity after the party Congress?
Not drastic change in the overnight fashion from a policy continuity perspective, because the easing measures for macroeconomy, many of them are already in place in terms of boosting infrastructure, in terms of stabilizing the housing situation. And for COVID-0 policy relaxation, I think a staged approach is more appropriate, given that you need to first boost the vaccination penetration, and potentially you want to roll out more medication availability and potentially domestic mRNA vaccines, and also you need to educate the general public for a reopening roadmap. Yeah.